And that's for me.
Location fits into it. So the long and the short of it is.
How about at the end of the day, do you do anything? Like, I'm really fascinated by rituals.
So I think it's really important to be ethical and make sure you're paying them well above.
Renovators is that, when you look at a property perspective, it's your home.
Hello and welcome to the very first Rask Invest Live. If you can hear me, say good day. I can see a few folks are already in the chat. So let me know if you can hear me. I want to make sure everything is coming through loud and clear on your end. Obviously, we do these pretty regularly, but I just want to make sure that everyone can hear me and there's nothing wrong. So if you can, say good day. Am I speaking to myself, which would not be the first time? Let me know. And I can see there are a few comments already in here. Okay, so Thomas, all okay. Ben, thank you. Wonderful. It's not just me. That's good to know. One of the things that happens when you're at home and you're wondering, does my internet actually work? Am I going a bit nuts? So Marco, Connor, everyone, thank you so much for letting me know. Because on my end, it looks like, who knows? But it's my pleasure to have you with me because we are rebooting what was probably the most, engaged thing that we've ever done at Rask, which is the live show. So some of you may know that for years we did something with Self-Wealth, the wonderful team at Self-Wealth. And then we moved on and did our own version of it called Rask Live. And it was really popular, like really popular. But what actually ended up happening is I did it for 3 years and I did it most nights, or in fact, every week for 3 years in the evenings. And that was, 3 years is a long time to go. So it's good to be back, and it's good to be back in action. Good to see you in the chat, Navar, Bruce, Chris. And we're going to be doing this. If you're over on Facebook, hello, Jeremy, welcome. Most people tune into the Rask network through audio, to the tune of about 8 out of every 10 people that tune into a podcast listen on audio only. But what we've found over time is that when we do these live shows, 9 out of 10 people listen on YouTube, some people on Facebook right now, Jeremy, Kylie, and some over on X. But for the most part, YouTube is growing exceptionally fast. And I think one of the reasons is that obviously with the arrival of things like OpenAI and ChatGPT, more and more people are turning to search assistants rather than going directly into search results. And that means that Google is responding by trying to funnel people into YouTube. And that's creating this huge swell of content creation that's going on over at YouTube, even more so than before. And so we've seen with our YouTube channel, it grow over 100% in 12 months. And it's got no signs of slowing down. So, yeah, absolutely love it. Financial freedom, good to have you back. Derek, always a pleasure, mate. Okay, so today is very unstructured because today is our first one, but there is always a Charlie Munger or Warren Buffett quote. So I do have something to throw at you just to begin with, which is a quote from Charlie, which is something that many of you will have heard before. I'll get rid of all that. And you can see my screen here, and it's just go to bed smarter than you woke up. And it's a really simple quote. And I figure if there's one that we could start with, if this series goes on to, stretch out over another 3 years or another 10 years from now, wouldn't this be a good quote to come back to, which is from the late, great Charlie Munger, who summarized a lot of his thoughts into this Poor Charlie's Almanac book, which was somewhere on the shelf behind me, or maybe it's in one of the cupboards, or maybe it's next to my bed. But the Poor Charlie's Almanac book is definitely a treasure worth having in your house. This copy here was about $150 because this is a hardcover 3rd edition, and they're pretty hard to get your hands on these days. It's more of a picture book, but it's wonderful. And I think if we all attend these types of things, which you in the podcast, as I know you do, then we'll all go to bed a bit smarter than we woke up. And hopefully I can help with that. And hopefully you can help me as well. As always, we've got to ask if you're subscribed and say the big fat general advice warning. Now, our general advice warning has actually increased, believe it or not. This part is what we used to do, but now we've got this part because now that we manage people's money through Rask Invest, we have additional disclosure documents under the guise of the Australian regulation. We have to increase our disclaimers to you now. So with every additional thing that we take on at Rask, there is an additional disclaimer. So if you do invest with us, you will have seen our Rask Invest product disclosure statement and target market determination. So if I mention Rask Invest and I talk about investing with us, I'm talking about the investment service that we offer. Now, that's not for everyone. We're going to talk about a whole heap of other things, but that's where you need to go. You need to read those things. And in fact, you can't even sign up without reading, with acknowledging that you've read those things. The other part of it is the most important part, I think, for what we do here on the live show, which is just that even if I do answer your questions, and we're going to talk about a lot of things that we've already put in the chat, I don't know your personal circumstances, your needs, goals, objectives. So speak to a licensed and trusted financial planner. You can check for one of those on the ASIC website. You can go to our website and get matched with one. And just make sure they have that AFSL. That's the number that identifies them and makes sure that they're legit. We've also got something called an FSG on our website, a Financial Services Guide, which if you haven't seen it, it's pretty boring, but it is really simple. So I'll show you what an FSG looks like. This is, if you ever deal with a finance person, make sure it's a legal requirement that they send this to you up front. So this basically lays out all of the things that we are able to do, say who we are, where you can complain, all that sort of stuff, our fees. Every finance business has to have one of these. So just go and check them out before you do anything. And I know a lot of you do, and you've already checked this out. So with all that said and done, the admin, let's talk about what the live show is going to be every week, every Thursday at midday. I'm open to moving the day, by the way, as is Mitchell and the team at Rask. But basically, the Rask Invest live show is all about investing, but there's going to be a bit of an intersection between investing and what we do in our personal lives. So how does what we do as investors, how is that fueled by the rest of the stuff that we do, whether it's in our careers, whether it's in the businesses that we start, whether it's in our what we learn and what we read and the resources that we use, the picks and shovels, all that stuff. How do we use that to grow wealthy? So it's going to be fun. As you can see, I'm pretty laid back. It's free. I'm going to try and keep it as practical every week as possible. You know, we're going to get into the weeds on company valuations. We're going to talk about ETFs. We're going to talk about saving. We're going to talk about retirement. We're going to talk about passive income, but it's going to be practical. It's not up in the clouds. So absolutely no BS. In fact, just even when someone says no BS, it probably should be no bullshit, because that's the whole idea of it. It's every Thursday at 12 noon, unless you guys say otherwise. It's available on replay on Facebook and YouTube each and every week. Even if you're on X, it's available on replay there too. You can join our free community. So at community.rask.com.au, and you can keep the conversation going. You can ask questions. You can respond to me or other people. It's totally free. You can go over there. I'm in it every day, and you can see what events are coming up at Rask. If there's an in-person event, if there's a live show like this one, we're putting more of our courses on there, so on and so forth. Also, it's not just for our people that invest with us. This is free for anyone. So if you have family or friends who could benefit from a show, send it over to them and we'll go from there. Now, this one is deliberately left blank. The other day, when we sat down and did the live show kind of outline, it was me and myself and a spreadsheet, classic. And I laid out 12 months of ideas, topics, guests, and people that I want to speak to. And I know that some of you have already put it in the chat. I think it was Lee. Welcome back, Lee. Says, hi guys, can I get in early and throw the first tomato at you? Absolutely, you can. What are your thoughts on VAE and E-market in the core? Too much overlap? Thomas, you've sent in a question. So wondering if the Jupiter portfolio is a good idea for passive income. So that's a different question entirely. But I want to hear what you have to say. What topics do you like to hear? Who do you like to hear from? I can give you a bit of an outline of all the things that I have started to lay out, which is in this quick and easy little spreadsheet. But I've started to theme up some of the months and thinking, if we're going to build this thing together over the next 5 or 10 years, what's it going to look like? Obviously last year we did a lot of in-person events. We did the live show in person, which was heaps of fun too. But we're going to have foundations. We're going to get some guests on. Some guests have already said yes. I want to theme a month around tax. I want to have one around authors. I want to have one around CEOs from the ASX or wherever. I want to have a thematic month, or retirement month. So I want to do all of these things and I want to explore them with you. But within that, I need to know what you guys want to know. And you can let me know by just writing in the chat or sending me an email or jumping in the community, whatever works for you. So basically all of the topics that we're going to explore together are going to form this kind of long arc of helping you grow wealthy, helping you navigate when things are uncertain. So it won't just be like the picks and shovels like ETFs or shares or property. It will also be the underpinnings of that. And I'll give you an example of this. We are launching the Rask Invest Live series, and we're going to do it with the support of some friends. And by friends, I mean big brands and household names. Lee, you've got Andrew Dermuth. Investing Dumbo, says Marco. I like that. You know what? One of the things, Marco, that I was thinking is, there's a theme, like it's not a good thing, but maybe we can bring some fun to it, is not so much poking fun at the Dumbos, which we're all a bit dumb from time to time. It's actually, maybe we could do something like, like Nightmare on Elm Street, but maybe like Nightmare on Wall Street or Nightmare on Collins Street, if we want to make it Australian, and talk about investing scams, frauds, and all those types of juicy things. So I really love them. And I think for like a kind of like serial type thing, we could track some of the big frauds, we could track some of the big cases that are in the media or the courts, and we could talk about them on the show, as well as identify some of the scams that you see on social media. Many of you will know that we have a big problem at Rask in that a lot of other like fake scam accounts, imposters on social media, copy our logo and our information and try and scam people into thinking that they're dealing with Rask when they're really not. And that's actually the biggest reason why I'm on social media these days, is actually just to stop that from happening. Like, so we can kind of like report different accounts and keep people safe. But that's like something that's really interesting to me, is like a counterpoint. So Cameron, you said, love to hear from you and other experts on portfolio theory and how it can be dynamic. You'll probably cover it today. Yeah, we'll get into that today. Lee says Andrew Dermuth. Yep, I believe it's spelled Deramyth, as in like a myth, because we don't actually know if he's actually a real person. Kelly, you've said, would love to hear from women in finance and specifically for SHAMs. I don't actually, who are wanting to run their, to invest in their families' futures and even possibly passive incomes supporting their single income. I'm sorry, Kelly, I'm going to need some education around this. I don't know what SHAMs is. I should know that by the sounds of it, but I don't. Marco, you said, yeah, the NAB guy and the ABS guy in 2007. Oh, that was a wonderful scam. So for those of you that don't know, when I say wonderful, probably not a good thing, but it wasn't so much a scam. It was like insider trading. So obviously I'm just doing this off the top of my head, so may embellish the truth a little bit. So you can go back and read all the documents yourself. But basically what had happened is someone who was working at the Australian Bureau of Statistics let slip on some information that would be released. And someone else who worked in a different firm used that information to place trades and make a lot of money. And they were found out. And that's a really good example, because just yesterday we saw the Australian share market bounce higher on for one reason alone, which was inflation came in lower than expected. And that now, fortunately for those of us that have mortgages and bond portfolios, I might add, that meant that the expectations are now that interest rates won't increase, which is really reassuring for people. Maybe they don't fall straight away, but maybe they don't increase. Daniel, you said, yes, who could forget the Adelaide Rask live show? Yeah, you know what I'm talking about, Daniel. You know what happened. Oh, Kelly, stay-at-home mom. Sorry, that's what the SAHM. I should know that. That's a good one. Yeah, we can do that, and we'll talk about this today, Kelly, because there's something that I wanted to speak with you about today. Is that if we go back into our topics page, which I was going to do before, I don't just want to help you invest better, because that's one part of what we got to do with our money. But I also want to talk about the other side of what we do. So if you think about long-term wealth creation, it probably looks something like this, right? Like we're going up, we're slowly increasing our net worth, which is what a lot of people talk about. And slowly over time, we get wealthier, right? Maybe there's like you're in your 20s and you can save more and more and more. Then you buy a house and you have to pay off interest. You have kids and things are like, oh, okay, it's a bit hard, but property prices start to go up. Then all of a sudden the kids are at school and you're starting to earn money again. Then you're going with your mortgage and all of a sudden you're starting to save for retirement. And at retirement, if we continued that chart on, it would look like something like this until eventually your wealth comes down again in retirement. Now, I don't just want to help you do that, right? Because if you think about it, if I could help you find the next best stock or the next best ETF, sure, we're going to make money from that. So that's great. We'll do that. But what about if I could help you earn more in the early days? Or if when you have kids, help you save money on childcare? Or if you're coming into retirement, help you use superannuation to grow your wealth far beyond what you could by just having your money sit in an investment property or whatever. Or maybe, in the worst case scenario, help you avoid disaster by making sure you have the right insurance or finding a better rate on your mortgage and how to do that. So like those are the things that are really interesting to me too. So there's kind of like an intersection. And one of the things that I wanted to alert you to is I was going to do this. I am doing this month with my partner, and it's totally up to you guys. How is this finding? There we go. Why don't we go like that? And why don't I put my screen like this? So now you can see a bit more. Okay. So I say everything like I'm going to talk about a few different companies and financial tools that you can use in today's show. And you can go away and you can think about them and you can use them yourself if you want to or not. It doesn't really matter to me because we don't get paid to talk about any of the stuff that I'm going to talk about today. Other than if you invested with us, which of course we would earn a very small fee. But all this other stuff doesn't actually make me or make Rask any money. I just want to show you these tools. So the first one I'm going to talk about is not to do with investing. It's actually to do with financial forecasting. And this might be the type of thing, Kelly, that you're thinking, yeah, this makes sense. So this is a brand that we've been working with on our podcast. They sponsor our Australian finance podcast. I hope I got that correct. And we do all of our long-term partnerships. We don't get, again, doesn't matter if you sign up or not, doesn't matter. But just for disclosure. Now, I'm going to start using this tool from this month with my partner because we want to do something called a financial detox. We know cost of living is a real thing. Our mortgage has gone up. We want to start saving more money so we can invest more money. So the way we are doing that is for the month of August, my partner and I, my wife and I, we are doing what we call a financial detox, which is where we track all of our spending and we cut the absolute bejesus out of our monthly bills. And you might think about this and you might be like, oh, that's a bit weird. It's kind of like doing a detox in your diet. You kind of cut out all the crap and then you reset. So for us, that means cutting subscriptions. It means cutting coffees out and having a coffee that you make at home. It means being more frugal when it comes to saving money on eating out or whatever. So we're going to start using this thing called PocketSmith, which is probably the Australian and Kiwi leader of tracking your finances. And so I'm going to start spinning this up. And so in coming weeks, you'll see me use this platform. Now, I should say that if you go into all of their videos and you see all of these resources, everything is in here. If I reference something, it's in here. So this is PocketSmith. Then you've got the Rask Invest, which I've already mentioned. We're going to talk about Perla, and we're going to talk about Navexa in a second. If you go into the show notes, you'll find this. This is about, I think it's like $15 a month. I should know this. Yeah, like this one right here is like $16 a month if you do it yearly. We're going to start using this at Rask because some of our team have already started using it and some of our community have already started using it and said it's awesome. So I'm going to start using that and tracking my finances, and you can connect it straight into your feeds. So Mick said PocketSmith is great. Been using it for years to track my monthly and annual expenses. That's awesome, Mick. Thank you for sharing that feedback. So that's exactly what I want because it syncs with bank feeds. And once I know it's a bit hard to set up, but once you set it up, it just is like on autopilot. I think about building businesses, right? Because that's what I love to do as well. but I think like building businesses, and I want like the best thing to make my life easy for investing. So the best brokerage account, I want the best budgeting tool, I want the best portfolio tracking tool, I want the best ETFs for Aussie shares, I want the best stocks for global tech. That is what we want. So for me personally, Pocketsmith, based on all the feedback that we've got, is where it's at. So I'm going to start using that. And if you see me reference it, you know it's Pocketsmith. You know we don't make anything from this. Like they do sponsor our other podcasts, but just so you know, it doesn't make anything from this. So that's Pocketsmith. Because I can't be bothered doing a different budget every single month. The second thing I wanted to call out was Navexa, and we've got Navar here in the chat actually. So Navexa, again, it doesn't pay us to do anything like that. You can see a portfolio here. We've got 3 portfolios set up and tracking inside Navexa. This is really cool because with Navexa, you can track ETFs, funds, stocks, US stocks, crypto, all in one spot. So if we're going to build a portfolio today, I want to work with you to build a new portfolio. So we'll call this, I was thinking about the name. What do we think about the name of our portfolio we could build together? I was thinking like the real fake money portfolio that we build on Rask Live. Something silly. So people know it's not real, but it's kind of real, but it's like a bit of fun. So we're going to set this up, and tax settings, it's just for an individual. Let's say that's all fine for us for today. If you did want to like figure out your own return, your own tax structure, what's optimized for you, you go ahead and do that. So now we've got this blank fake portfolio, and you and I are going to add some positions to it. And the good thing about Navexa is it automatically updates. You can set it to automatically import from a broker, but this is just something that you and I are going to create together. Now to start off, let's say we have, let's go with a stock, and I'm going to put it all into the BetaShares AAA ETF. So that's this one right here. This is just a cash ETF, and I'm going to buy, what's the share price? $50. I'm going to try and buy $1 million fake dollars of this thing. So 1 million, I'm just doing the calculation myself, so apologies, it's in a different tab. 105. So that would approximately get us 19,000, this many units, which is about $1 million of AAA. We'll say the brokerage cost is $10. I don't know, whatever. And I'll put a note in, starting position cash. So now we can pop this in, and we can see it. And there's a reason I'll come back to this. This is in our real fake money portfolio. We can see it's an ETF, blah, 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 blah. You can see historical performance. If you want me to explain why it looks like a shark tooth, I'm happy to do that. So that's there. We can see dividend yield, all these different things. It's all there. Actually, if we zoom out, this is a kind of cool chart. You can actually, since when do you see a share price chart look like this? If anyone wants to explain in the chat why this happens, I would love it if you did the explanation rather than me. We hold this ETF in our portfolios at Rask Invest, but if anyone wants to take a stab at why this is in here and why does it look like that, go for it. And while you do that, I'm going to hook up something else. I just got this in another tab that I'm working on, so feel free to bear with me. It's always a risk having a kombucha while you're doing a podcast or any type of discussion, because it's kind of like fermented. So it often results in a few burps, if I'm being honest. So keep that in mind. This is my fault. Okay. So now I'm going to switch. Literally switch. Hooray. Look, I've got $0. So this is Perla. This is a wealth platform, investment platform. So you can see it all here. You can see different ETFs. You can see whatever. Oh, I've got $1,400 in my bank account. Anyway, enough of that. So if we were to track down, say, AAA, which is the ETF we just put this fake $1 million into. Yeah, Chris, you got it, man. You said for the AAA ETF, the reason it looks like a shark's tooth is because it's got a monthly dividend. And Marco, you said the same. The drop is when the fund pays out a distribution. Vigisa said exactly the same thing. So the ETF, if we zoom right into 1 month, at the beginning of the month, it starts banking dividends. So it just takes your money, puts it in a bank account, and starts collecting interest, right? So over the month, it collects interest, just like at bank interest rate. And then at the end of the month, it pays that interest. And that's why if you invest in this ETF, effectively, what you end up with, there's a kombucha. What you end up with at the end is you get the dividend payment, quote unquote, dividend payment. It's a distribution, but whatever. At the end, then it pays out and that cash hits your bank account. So one of the reasons that we use this ETF in our portfolios is because it provides monthly income to our retirees. Now, if we zoom right back out, you can see, and this is what Jim's just brought up in the chat. He said that monthly interest compounded over time, so it tracks higher. So what he's talking about is this bit here. It kind of looks like it's increased, like a stock chart in bandwidth, even though this is like 7-8 years or whatever. You can see interest rates were really low. So at the time, people weren't getting much interest at all. And then interest rates have come up again, so term deposits are paying more. And that's what it actually looks like. But most people don't visualize that with their term deposits because they don't actually see that. So that's something to keep in mind. Now, if we move back into Perla, one of the cool things about Perla is that how simple it is. But you can see a bunch of information on different ETFs. Most people use ETFs on the Perla platform, which is kind of cool. It's one of the fastest growing brokerage platforms in the country. You can see the fee. You can see kind of everything we need to know here. You can see there's only 120 people invested in AAA. That's interesting. You can see the average investment amount is $42,000, which is great. You can see the income of these investors who invest in it. Mostly male. Interesting. So there you go. It's a small sample size, but you get the idea. And so Pearl is just a brokerage account, but it's probably, I think, we've been working with Pearl for a very long time. They're also a partner of us on the finance podcast. We do not get anything for mentioning them here on the live show. It's just an advertising agreement over there. But I just bring this up because this is how we're going to visualize stocks and how we're going to talk about doing certain things with a brokerage account, right? So we've got for tracking our portfolio that we're going to create together, we've got Navexa, and this also does your capital gains tax reports, your income reports, CGT, franking credits, all that stuff. It all goes into Navexa. If you set it up correctly, Navar can help you out with that. And for ETFs, obviously, we're not actually purchasing any with our real fake money portfolio. But if we did, you could buy them with Perla, Comsec, whatever else you use, and sync it into Navexa. And for our finances, we're going to use, when we visualize those kind of topics, I'll be using PocketSmith. And then the final thing is, which is probably the more juicy one for a lot of you, you're like, hey, it says $1 million in the title of the show. Help me out, Owen. So we're going to be using TIKR. Now, TIKR does anyone use TIKR? I'm just curious. Does anyone in the chat use TIKR for anything? Because I use it a lot. Chris says, Perla is great. Thank you, Chris. Chat, you've said, interesting. What happens if you purchase purchase AAA the day before the cliff? So if you were to buy, where did it go? Here. If you were to buy the BetaShares AAA ETF, say today, let's use that as a good one, Jat. Say you bought it today, which is right here. Well, you'd be buying it after it fell off the cliff. So what you would be getting is not the dividend. You would just get the next month of it going up. So effectively buying it at the bottom. If you bought it the day before, depending on what they call the record date. So if you are on the record date, meaning that you are recorded as the legal owner of that investment at that day, you should get the next distribution. But it's not like you can time it so that you buy it at like 3:59 or something like that the day before it closes or whatever. So you just got to, it's more of this ETF, the reason that it exists is people think, well, why don't I just put my money in like a term deposit myself? The reason that this exists and is super popular, even for investors like us, like professional investors, is because when you have a brokerage account, and I would encourage all of you to go and check this right now, maybe actually do it after the show because I don't want to see you all leave. But if you are investing right now, go and Google, does my brokerage account pay interest? And Google the name of your brokerage account. Chances are they don't, or if they do, they pay you bugger all. And the ones that the financial advisors use often pay even less interest than the one. So the bigger balances typically pay no interest, and no one's paying attention. So what good financial advisors would do, or in our case, what we do, and you can do it too, is use an ETF like this. And sure, it might cost you, some brokerage fees, but at least you're getting monthly interest. And then when you're ready to invest that cash that you haven't decided yet what you want to do with, you can go and you can sell this one and put money in the other thing. But the thing is, you're like, well, why don't I just, that's not me. Why don't I just buy something? Yeah. If you're just the type of person that just buys a different share or ETF every month, you don't need to worry about not getting any interest because you're invested straight away. But for a lot of us that have big portfolios, like is in like retirees, or we manage professional portfolios, this ETF and others like it, like the Bill ETF, BILL, are very, very, very important. So Mick, you've said it, like you don't get any interest on your brokerage account, so you're using AAA. You'll be surprised, guys and gals, how you're not making interest, even if you have one of those like particular savings accounts, like say ING, who I bank with, is a really good one. They pay a really high amount of interest on their savings maximizer. But in order to get to the savings maximizer interest rate, you have to do a bunch of things. So if you don't use it in the correct way, they're not going to pay you barely any interest. So keep all that in mind. And that's real now that, you can get interest. Okay, so what do you want from the live show? We've already started. We're going to start talking about building out a portfolio in just a sec. I've given you some tools. So we've talked about that. The first month here will be more about the foundations of investing. So go like that. Is coupon a good alternative? So coupon, from memory off the top of my head, Viggies, coupon is it's a floating rate ETF. So, okay, so how do I visualize this? Okay, so coupon, this ETF, I would not put it in the same category. So say, for example, and I'll get out my Mr. Squiggle here in just a moment. Here we go. So say, for example, oh, my hand's a bit cold. I'm not doing my Mr. Squiggles very well today. So say, for example, on this axis, let's go back to year 12 or whatever it is, we've got risk. Actually, yeah, that's a fine. And on this one, we've got, let's just say income rather than return. So we're just talking about risk and return. What it is you typically have something that's like no risk would like sit here, and then you'd go out from there. Let's make that a different color so we can all visualize that a bit better. Let's say it's on this blue line. So typically you have something like this. Now risk, contrary to what you might be able to visualize here, risk is not on a straight line. Like it's not linear. It's like the next step along is the same amount of risk. That's not how the world works. But term deposits and government guaranteed savings accounts are probably like right down in here. AAA, because it's an ETF and it's not a government guaranteed term deposit, it's probably here, right on the risk. So it's like lower risk. It's got good income. But if you go a further step out, you've probably got government bonds, and then if you go a further step out, you've probably got like debt instruments. You go a further step out, you've probably got like, I don't know, property. You've probably got blue chip shares. Then you've got small cap shares. And then way off in the distance, right at the back here, you've probably got crypto. That's just me taking a jab at it. But anyway, what we're talking about with AAA is sitting more in this realm right here. So I'll just put 1A there because my fingers are frozen. It is cold here in Melbourne, by the way. So AAA would sit right here, right at the bottom of the risk curve. Something like a government bond ETF would sit here. So I'll just put B for bond, like James Bond. And then you've probably got something like what you're talking about, which is coupon, which is a bank senior floating rate bond ETF. So it's an ETF. It's less risky than, say, a single bond that you might buy. It's less risky than, say, a stock. It's less risky than, say, a property. It's less risky than a bunch of other stuff, which would be further up. But it's not as safe as the other things. Why? Because a floating rate means that the income that's received can go up or down. But it also, see how it says senior? So what that means is if you have, say like you have a company, right? Typically a company is made up of what we call capital, and you have some shareholders who put their money in to start with, some of the management team, maybe the founders, and then you have the debt investors. So like, let's say like the banks that give the company a loan. And within that, you also say if this company was 50-50, it had 50% debt and 50% equity. In the debt component, which is the bit at the top, they get paid out first in the event of a collapse of this company. So it's like if you bailed on your mortgage and you never paid your mortgage, the bank would be the one that gets its money before you get what's left over. It's the same here. So in this instance, what we're talking about are senior loans. Senior, meaning that of the capital stack, they're near the top, right? So they're up the top here, meaning that they would get repaid first. So they would kind of maybe sit in here as a senior loan. That just means that in the event of a collapse, they would get more of their return first before the other people get their money back. So that means that within its own little world, it's of a safer variety. It doesn't mean that it's safe completely. Doesn't mean that it's safe relative to other types of things. But it does mean that of its little asset class that it sits in, it finds itself in, it's one of the safer variants of that. But at the same time, it doesn't necessarily mean that it's, good or bad. It's just that it's a different type of thing. So I consider this type of thing not to be in the cash allocation. I consider it to be 1 or 2 steps to the side. So you're going a little bit more risky, but you're going to have some ups and downs, and it's going to change. And it's something that I think about. Brenton, still anti-crypto? Not anti-crypto, Brenton. We had a good chat in the community last night, actually. Where was it? We had a good chat in the community last night. Like, if people want to own it, that's fine. It's just not for me. Where is it? Iggy asked the question. Yeah, Bitcoin. Totally fine if people want to own Bitcoin. I lost my password to it ages ago. So I've lost my whatever token amount of money I had in there. So if you do see an NFT of my face getting around, yes, I did create that. And no, I don't have an ability to remove it from the blockchain because it's there forever. Yeah. So Mike, you said you use a Macquarie high interest savings account. Yeah, a lot of people do. Yeah, so most of your non-emergency funds are straight into the market. And you're anti-crypto. Okay. I don't really like to take too many sides. So I just don't really like certain things about certain things. So I wanted to ask, did anyone use TIKR? There's like 300,000 people, they say, that use it around the world. I'm one of those people. Do you guys and gals, do you guys use it? Tell me. Like, do you use TIKR? If not, well, welcome. I'll put a link in the. I'll just put this link straight in there. There is a paid and a free version, I think. So I just put it in the chat. So this tool basically allows us to study companies. So one of the things you can do with it is you get like the best kind of company financial data or data. Who bloody knows, really? Data. I don't think there's an R in there, but we'll go with it. So you can use this to study all the financials of a company. But one of the things you can also use it for is you can use it to screen for companies. So some of you may have heard the idea of a screener. So say, for example, in this instance, we wanted companies on the ASX, so the Australian Stock Exchange, and we wanted to see their stock price change over 10 years, like how they performed in stock price. But we didn't want any of this crap. So we didn't want companies that are in the metals industry. We don't want REITs in there. We don't want tobacco. We don't want banks. We don't want insurers. We don't want biotech, airlines, Rex. We don't want any of that sort of stuff. And we only want companies that have a revenue over $50 million. So that just like gets rid of all the crap down the bottom of the ASX that might go from like 0.1 cent to like 10 cents. And it looks like it's the next Apple when really it's just tiny. So we can do stuff like this where you click fetch screen and it's going to screen the entire ASX and shake it around a bit. And what pops out are companies that have met our criteria. So we can see here that like Woolworths makes the cut, Wesfarmers, Coles, Telstra. But if we rank it by the price, we can see Pro Medicus. Hey, here we go. Pro Medicus is the best performing stock in Australia over the past 10 years, assuming you get rid of all the crap. Not crap, you just get rid of all that stuff. So you can see here, Pro Medicus is up 15,000% in 10 years. And by the way, guys, I did not plan this. I do own Pro Medicus shares. Hub24, which is an investment company in second, Polynovo in third, which we spoke about on the Australian Investors podcast recently. Codan, which does like metal detection and electronics equipment. Macquarie Technology Group, I don't really know that business too well. Jumbo, which is a gaming company. Data3, which is a technology services company, IT services. Australian Ethical shares, and NextDC, which is cloud computing. So you can see all of those companies there. You could do the same thing for whatever. So TIKR, yeah, I can see Giles use it. TIKR is about $20 a month. I think it's the best value for money of any of the tools that you can get. Finally, what you can do with it is you can go on this Track Investing Gurus tab, and you can look for all of the famous investors, mostly US, but some others. And you can say, for example, Berkshire Hathaway here, and we can see Warren Buffett's portfolio. Obviously, the guy who runs Berkshire Hathaway. And you can see 38% of his portfolio, let me zoom in a bit, is just Apple. 11% of it is Bank of America. 10% is American Express. 7% is Coca-Cola. Chevron is 5.5%. Occidental Petroleum is about 4.5%. Kraft or Heinz is 3.4%. Moody's is 2.7%. Chubb 2%, and so on. And you can look at this because they have to update it every quarter in America. That's the current rule, but it can be delayed. So it's not exactly what's happening there and then. But for example, we can see that sometime recently, he sold 12% of his holding, 13% of his holding in Apple, which was equivalent to $116 billion. So he sold 116. That's just number of shares. So number of shares, 116 million would be who knows what in actual dollars. Emily said, are these tools you'd suggest for a brand new beginner? I may be brand new for this call, but I'm still listening in. Emily, you're in the right place. Today's session, the first session, is all about introducing you to the live show and some of the tools that we'll be using. Now, TIKR is not one of the basic tools. So this would be like a more advanced tool if you want to invest in individuals, companies, or shares. Perla is good for beginners or advanced people. I use it. But I also bought shares for my sister using it. And well, she gave me the money. Let's be real. It's not my money. She's only 14. She saved up and she wanted to buy some ETFs after I introduced her to the idea. And I cannot remember what she bought. I hope she doesn't mind. I've got a little account here for Jenna. She bought VAS. Go get them. So she bought VAS. She's up 19%. It's actually her birthday tomorrow. So I should let her know she's made a 20% profit on that, which is awesome. So that's for beginners or advanced. Now, this one, Navexa, Emily, is a tool that is available for basically anyone because everyone has to kind of do a tax return. And everyone has to do their investing admin. And so if you set this up, it does seem a bit technical at first, but you're going to receive dividends and you're going to pay capital gains tax on profits. So what you can do is you can sync them up so that your brokerage account talks to this. And then that way you don't really need to check in until your accountant asks you, hey, Emily, did you make any profits or earn any income from your investments last year? Oh, I don't know, but I can check Navexa and Navexa will spit out a report. And then finally, PocketSmith is for everyone. Like you don't even need to be an investor to use this. You can see it syncs with so many different banks, American Express, ComSec, it's like an experimental feature, Commonwealth Bank, ING, Ubank, Westpac, whatever. So this is more about like knowing where your money goes and then forecasting. That's the powerful thing about PocketSmith, is it forecasts. If you did this, what would happen? And that's what makes it super powerful. That's what makes it really, really powerful, in my opinion. So that's why it's got like 200,000 or 300,000 users, even though it's a paid thing. So I hope that answers your question. Anyway, back to this. So there was a good question here. Pablo, Owen, are we still waiting for your thesis for e-market versus IEM versus VGE? Will it come? Yes, it will. Pablo, just give us a second. I can talk about that quickly. I just want to finish Vigis's question. So I explained this before about the risk. You say, is that the reason the distribution for coupon is higher? Yeah. So if coupon was the ETF that you were looking at, or anyone was looking at, I should say, and you scroll down and you see it's got this thing called running yield. This effectively shows you what's the yield of the investments inside it. You'll see different words. You'll see like trailing yield, current yield. Most of the lingo will say running yield for something like this. So that's effectively saying 5.33%. So let's just pop that in here. So 5.33%, right, for this one. But if we go to say, what was this one? A government bond ETF. So let's just say we go to IAF. So IAF is a bond ETF here in Australia. It's one of the core building blocks that we use at Rask Invest. So if we scroll down on this page, this is lower risk, but it's a bit different. So this has a yield, let's say just when we take the running yield, 3.1, right? I'll take this number right here. I'm going to pop that in here, 3.1. And then finally, let's look at AAA. Beta shares, AAA. It's a good ticker symbol. So this is just the cash ETF. It just puts money in a term deposit for you, basically. This one has a yield of 4.46. So let's pop that down here. 4.46. So let's just zoom in a little bit here, not just for Vigis, but for everyone. So now what we can see, all right, guys, is we can see, if I just bring out my other thing, go with green, we can see that this one up the top here is 5.3% per year, but it's variable. It can go up and it can go down, right? It can go up and it can go down. So the income, that's why it says floating, because it floats up and it floats down with interest rates. Now this one here, which is also floating, so this one is a term deposit. Think about it like, even though a term deposit is a fixed rate, if you did a 30-day term deposit and you just kept on doing 30-day term deposits for the next year, the annual rate would change, because 1 month it'd be higher, the next month it might be slightly lower, the next month it might be slightly higher, because banks change their interest rates. So even though it's fixed for 1 month, perhaps, it does change over the course of time. So that's what we saw when we looked at the chart. We saw that it was paying nothing, and then over time, as interest rates went up, it collected more monthly interest. That's why you see that. But this one in the middle here is a bit different. This one in the middle here is only paying 3.1%. So you might be saying, well, why is this one more when you're saying it's lower risk? So why is it giving more income when it's lower risk? And why is that one not that much more than this one? So there's a few reasons here. First of all, what makes this one higher risk is that the value of the ETF can go up and down, not just the income. So the ETF can fluctuate in price as well, right? So the income can go up or down. So that can go up and down because it's floating, remember? But also it's got some risk because it's up here. It's, not investing in the government. It's investing in bank debt, I think. So the income can go up. It also has what we call default risk. So maybe it doesn't make some of its payments. But also the value of the investments inside can go up and down. Not as much, but they can go up and down. This one down here has no real, there's not a massive risk. Of course, there are risks involved, but it's not as big a risk because it's mostly cash. But, banks can default. The interest can fall. That's the biggest thing, like we saw. But why is this one standing out? Why is this one paying less in income, but is not as risky as this one? But why would it be included if you could just get this? The reason is this is a government bond ETF. So the bonds, the things that you're investing in are actually issued by the government, which is more secure than these ones up here, which are issued by banks. So the government is safer than banks. But the government, these bonds are also long-term. So if we go in here, and I hope I'm not losing anyone because bonds are boring as, let's be honest, batshit. They're boring. But they're essential when you build a portfolio. So if we look here, we can see the average maturity. If we hover over the tooltip, we can see the average maturity is 5.8. And basically what we're saying is here, the things inside the ETF are long-term. They're long term. So even if interest rates fluctuate, you're going to get a good yield. And that's why they're included here at a lower yield, because that lower yield, yes, it's lower, it might go on for longer. And that's the difference. So if you've gone to, say, like a website, let's say someone mentioned Macquarie before. Have you ever wondered when you go to a website and you look at it and you're like, okay, so I can get 4.95% per year for 3 months, or I can get 5.1% for a year. How about if I go longer? If I go for 4 years, how come it's less than if I go for 1 year? That's because the bank is saying to you that we think interest rates are going to fall in the future. And so they're not prepared to offer you as much. And it's the same when you use bonds. You can use bonds strategically so that if they do fall in the future, you're effectively kind of like locking in an interest rate. And that's why this is there. I know we went deep into the weeds there, guys. But I hope that makes sense. Emily, you've said, I have never done anything to do with shares/stocks and brand new to it all. So with no one in my life who does it, has ever talked about it, like learning Spanish. Well, yeah, I don't speak Spanish, Emily, but I can imagine that this would sound like that. But hopefully we can break it down each and every week. And all of these are on replay, so you can go back as well. We know we've got our podcast and community if you have any questions. Did you know that? You say, do bond ETFs ever come to term and pay back the initial investment? Yes, they do. Or because it is an ETF, is it always refilling and never pay out? If the bond ETF goes down in value, can you lose money? Yeah, so what happens in this instance is most of these bonds roll over. And probably the analogy that you want to remember, did you know that? Good YouTube handle, by the way. What you want to remember is just imagine a snake eating a pig. When the snake eats the pig, it kind of digests and it goes through the snake, right? Think of those as the new bonds. They're passing through. And then out pops the other end. When they mature, they pop out the other end. And then that money is then going back to the front of the snake, right? And so every time there's a new bond coming in, it might be every day, it might be every week, it might be multiple every day, who knows, right? And every time interest rates change, effectively, that snake is eating whatever is coming out at the time. So it would be interest rates right now. Obviously, in time, as it goes through, like over the next couple of years, the bonds that it's eating today take a few years to pass out the other side. So what you're getting is this snake or an ETF that holds all different types of bonds. And that's why it takes time for the ETF to show a higher yield, even though it's getting higher yields. It's eating them now. It takes time for the lower yielding bonds to pass through. But what you need to focus on is like the ETF as a whole. When they mature, they pop back in and they get new ETFs, new bonds at the start. I hope that makes sense. Yeah, bonds are boring, financial freedom, but they make up 10% of my portfolio. Okay, in the interest of time, I'm going to jump to the question from before, which was also asked earlier. Pablo, are we still waiting for your thesis on e-market and versus IEM and VGE? Good question. So, excuse me while I talk my book for a moment, but this is clearly what lots of people want. You give it to them. So inside our portfolios, and I'm going to do the whole reveal of what's actually inside our portfolios. Yes, I've got to do two-factor. I've got to do two-factor authentication, which I haven't set up. Oh my God, Mitchell will be able to do that for us. But inside our portfolios, if I click on one of them, by the way, guys, just announcing it now, two-factor authentication was mandatory from today. So clearly I didn't do that this morning before the live show, but I'll do that in a moment. So inside our portfolios, people will know that we recently made a decision to sell FMEX and replace it with EMKT. Now, if you want a full discussion of this, it's all available on the Rask YouTube channel. So I'll show you just real quick. It's this one right here. I'm going to pop this in the chat, all right, guys? So you've got it here. Or if you're stuck, just remember it's the Rask Invest June portfolio update. So Mitchell and I went into detail about why we made the decision to sell FMEX and switch across to EMKT. that is happening probably in the next couple trading days, just so you know. That's when the switch will officially occur, and it will rotate through all portfolios. With our process, when I authorize a trade, obviously I have to get permission from the investment committee, and then I authorize the trade, and then the trading team goes and does that. It can take a little while. It can take a couple of days. So just keep that in mind. The good thing about ETFs is there's no major rush with them. So why have we switched? Well, that video does capture a lot of that. But the big thing is that we've been invested through our core portfolios. Actually, I can show you this rather than you seeing my face. So many of you know we have the investment portfolios that we do for you now, which is Rask Invest. That only launched in about April this year. But for years, we've run other investment strategies through our website, and you've been able to follow along in Perla. Like a lot of our investors, Perla is the second most popular platform, and people use, please go away, people use Perla to track our investments. So what we have in our portfolios, they then go and trade themselves in Perla. That's completely fine. That's how our business was set up many years ago. But what's important to understand is that inside our portfolios, we've held FMEX for quite a while. You can see it here. You can see it looks like we have a dividend we need to confirm that we've received. So you can see that here. I'll confirm that. And the reason that this is important, I've got a lot of questions recently about like, why did you sell FMEX? Why have you told us you're going to sell FMEX and invest in EMKT? The reason, it's not like I just come up with this idea in the last 3 months. We've held FMEX for a very long time, and it regrettably hasn't performed as well as I would like. So if we go back to our original chart, like say we looked at this before as like, this is the safest, this is the riskiest. There's a whole spectrum of things we can invest in. Now, if we think about the things we could invest in, emerging market shares, commonly just abbreviated to EM, emerging market, is things like China, India, Asia. You can include some other places like South America, that sort of thing, right? Now, in this instance, these things are really out here on the end of the risky spectrum compared to cash that you could just put in your bank account, or if you're like my grandma, you put it in a jar and you bury it in the backyard. Turned out to be risky for her because she actually forgot where she buried her cash. But this is the safer stuff. This is the riskier stuff. Now, we've held this position for quite a while, so we're switching it out for EMKT. And the big difference is that this one that we've had, so we're switching out of FMEX and into EMKT because the one that we've had is an active strategy and it has a higher fee, and it just hasn't performed as well as we would like. So you've got to know when you're at the end of the rope, and have we given it enough rope? And I think we have. A few years of holding it, we've given it enough rope. It's time to switch. We move into EMKT. It just looks like this. I'll explain to you maybe next week or the week after when we start talking about shares and ETFs, what this actually does with like a lot of precision. But basically, this ETF is not fully passive like an index fund, and it's not fully active like FMEX. It's somewhere in the middle. It's called multi-factor. It still uses rules, so like rules that are like written in code or in a spreadsheet to pick and choose different stocks to buy from China, from India, from places like that. But the key distinction is it uses a few different rules at one time. That's why it's called multi-factor. And it's a good performing ETF. It's lower down the fee spectrum, so we don't pay as much in fees. It's got an established track record now. It has a pretty respectable income yield as well if we scroll down. So even though it's investing in shares from emerging markets, if we scroll down, excuse me, Van Eck. And there has been quite a bit of discussion about this, I should say. There has been quite a bit of discussion about this in the Rask community. So if you are of the opinion that I'm making a mistake or that you think something I could do better, or if you just want to give me feedback, you can do that, and as well as any of the team over in the Rask community. And so you can see that there. I hope that makes sense. So we're switching out of this because my fundamental belief is that in emerging markets, we should still have some type of protection in place versus an index fund that is just purely buying everything. Because in those markets, you tend to have a slightly different governance framework with those countries and their political systems, but also with things like their reporting systems and their financial regulations. They're not as robust. So, and finally, even though this is like half active, half passive, if you think about it, like it's not using humans, but it's using rules made by humans. This fee of 0.69 is equivalent to a lot of the index funds. So it's not like you're paying a lot in fees to get a semi-active strategy. I hope that makes sense. There are risks. Please read the PDS. Okay, finally, before I get to your question, James, I'll answer that in just a second, mate. But I want to just call out a few things. Okay, so everything that I reference should be in the show notes or if you go into the video, so I'll click on an old video so it doesn't look like an infinity mirror. You should be able to see all of the show notes and resources, right? So if I reference something, go and check it out, like the community. If I reference PocketSmith, Perla, Navexa, whatever, there'll be more in the next week. I haven't put the ETFs in, but you can just Google it as I go. That's all available in the show notes. If you want to join me in the conversation and other people, just go and create a free Rask community account. It's free. You can start to enroll in courses. Troy, I didn't get to your question today. I will try and get to it tomorrow with Drew on the Australian Investors Podcast, which will go out on Saturday. I did see that. You can invest with us if you want. You don't have to. If you do want to invest, you can use Perla, Comsec, SelfWealth. You can track your portfolio with Navexa, or an alternative is ShareSite. I'm going to start using PocketSmith, so I'll let you know about that and how that goes, and you can play along if you like it. Goodo. You can get free courses on Rask Education. Now, I want to just quickly let you know about what's coming up in the next few weeks. So we're going to start inviting guests onto the Rask Live program. If you want to create a calendar reminder, you can do that because we'll be here every Thursday. So you can just say, go to the Rask YouTube channel and have your lunch. But you can also go to the Rask community and you can set a calendar reminder. If you go to the events section, and I'm obviously going, but you can select going, or you can add it to your calendar here, and it sets a reminder and then puts the link in there. So just as an FYI, that's how I do it. Obviously, I host the darn thing, so it's a little inside tip. In the coming weeks, starting next week, and this might be really useful to some of you. I hope it is. So next week, I'm going to talk to you about the absolute foundations. And by foundations, I don't mean just beginner stuff. I mean, like, how do you build an ETF portfolio? That's next week. We're going to start with the foundations, the core, right? Core's next week. Just remember that. The following week, we're going to talk about Aussie shares. I'm going to take you through an investing checklist. You'll be able to download the checklist. All of that stuff. We're going to talk about franking credits, dividend income valuation. Like, again, even though I say foundations, it's not basics and it's not advanced. It's kind of all mixed into one, like what you need to know in 60 minutes. The next one, we're going to talk about US stocks because I absolutely love talking about US stocks. That's at the end of this month. We'll just be coming out of US reporting season. So we'll talk about some companies. I think in both of these, I don't know if I've got it here in my notes, but I'm going to identify some of the best performing US companies over the past 10 years, and we're going to dive into why that is the case. Finally, we might even bring an expert on for this one, but we'll talk about investment property, or just using property as a wealth creation strategy and how that ties into shares, super, tax, all that stuff. Because the reason that I wanted to do these first, guys, is that I think that it makes sense to kind of give you the absolute nuts and bolts. Because then when we go on and we move on with other topics that you suggest or whatever, we can refer people back to things, and it also forms a really good base. And every month, we're going to hopefully build this portfolio together. Now, I was thinking of a name, and anyone can just throw out a name for me, but I was thinking of a name as the name that we put in here in Navexa is just the Real Fake Money Portfolio, or something fun. And we're going to create this fake real money portfolio over the next year together. And we've just put $1 million of hypothetical, let's call them Navexa dollars. We've got a $999,995.59 of Navexa cents. And we're going to start building this portfolio. And the reason why it starts with AAA as an ETF is because that's our cash. I'm imagining that we've got cash and we're ready to invest. So we're going to build it together. Now, these are not our official portfolios. You can head to the Rask website. We're going to have a bit of fun. All right. We're going to have a bit of fun. We're going to look at stocks, thematic ETFs. We're going to look at all that and we're going to track it. And you can track it and you can check it out and you can contribute to it. But we're going to build it together. Now, if someone comes out with a really crazy idea, like, hey, put 100% of it in crypto, we're probably not going to do that because it's not really a learning experience. But maybe it is. Who knows, in a roundabout way. Monopoly money, Monopoly portfolio, says Sienna. Name idea, a Rask investment. I like this. I like all of these. If you do watch this back on replay, please put it in the comments. I do read everything. Mitch's cat name. So for those of you that don't know Mitch, Mitchell is our head of funds management at Rask, and he has this cat that always, I only ever see it when he's doing a live show or a podcast for Rask or like a really important thing. And it comes in and it stumbles across his keyboard and looks around and then just makes a fuss. It doesn't do it any other time of the day, Mitch tells us. So whatever Mitch's cat's name is, maybe we can name the portfolio after that, assuming it's a funny name. I don't actually know what its name is, but we could do that too. Crazy Rich Australians, Mick. It sounds like a bit of a play on words. I like that. But my basic principle of basic idea, guys, is I want us to create this portfolio together, have a bit of fun with it, research some companies, research some ETFs, put whatever we want in there. And then at the end of the year, we'll have a look at it. All right. And then we'll set it free and then we'll start the process again next year. And so we build it for 12 months and then we'll set it free. And then in 5 years or 10 years, we'll come back to it. Right. And then we'll just keep reviewing them in the future. So to begin with, let's start with that. And obviously all of us here today, while the show is new, we're going to have the maximum possible impact. Whereas in, say, 2 or 3 years, when we're getting 15,000 people that might watch these shows and then start to watch them regularly again, then of course there might be a few more voices. Retail and do not, Giles, you made me almost say that. So Giles has put something in the chat, which is retail investor portfolio. Retail. Obviously, Giles knows that I hate that word, retail, and it's not because, we all like going to Cotton On or Kmart or whatever. That's not the retail we're talking about. In finance, the finance industry tries to talk down to you, and they call you retail investors as if you're just some pleb that's going down to the local Westfield and you're paying full price. I hate it. I hate it. We're all investors. We're all the same. I do not like that term. So thanks for getting me riled up, Giles. Obviously, there are reasons why people might say mum and dad investors, which I think is more endearing than retail. But I just hate that. So I'm going to lampoon that from this moment on. No more retail investors. If anyone comes on the show and they say retail investor, other than for the legal definition, we will just turn off their camera. No more. None of that. I hate that. No more like us and them. It's not happening. Only investors. That's the only thing that happens on the show from now on. So thank you again for getting me riled up there, Charles. Okay. The other thing is I'm going to answer a question, which is from James. Owen, in your interview with Balaji Gopal from Vanguard, he said he likes VDHG held the underlying managed funds rather than the ETF variants. What situations would dictate holding an ETF or a managed fund? That's a good question. I'll be real quick because we're already gone over time. So many of you will know that this ETF is very popular for beginners, and I think it's a great option for beginners. Let's start with that. It's a great option for beginners. We had a really good conversation about this in the community. I'm going to bring this up just real quick. Search VDHG. Wait for this to load. Let's see. This one. So I'll put this link in the chat here. Ray says dumb money. Isn't dumb money that thing in the US with or is that, I don't know what that, maybe it's not dumb money, but I like it. I like it, Ray. So this ETF invests in managed funds. So this would be like, if an ETF is a basket, this would be like a basket holding buckets. So imagine you've got one big basket and in that basket, you've got buckets. That's what this is. So rather than just buying the basket, you get the basket, but inside of that, there's another layer effectively. So this is kind of like an all-in-one portfolio. And it's a good ETF, especially for beginners. Now, we don't use it, and there's a few reasons why, and I laid out in that discussion. But you can see it's got a bit of Aussie shares, it's got a bit of international shares, it's got a bit of bonds, which is this orange, it's got small companies, which is the pink, the emerging markets is the green, and the bonds is this yellow. So it's kind of like a diversified portfolio in one. I think it's a good ETF, as I said. Now, the question is quite nuanced in that your question, James, is about why does it hold managed funds and not ETFs? So all of these individual things here are managed funds. They're not ETFs. That's a common misconception. People think that this thing is an ETF of ETFs. It's not. Sometimes we might describe it like that because it's easier for people to wrap their head around. But what it actually is it's an ETF of managed funds. And that's because when it launched, the way Vanguard thought about it, in my opinion, was, hey, we've got all these ETFs, all these funds that are great, these index funds. Wouldn't it just be easier if we let everyone buy all of them in one go with different mixtures, like high growth, balanced, conservative, all growth, maybe, but they don't have that. But that's the example. And so what they did is they put a big, they got all of these different funds, managed funds, think of them as the buckets. They got all of these different buckets, and then they put them in a basket. And they called this basket VDHG. There's another one called VDBA, VDCO, VDGR, all these different baskets. The problem that you have is that when you have an ETF that's got managed funds inside it, is it can create some tax issues. And I also think that 10 or 20 years from now, I think Vanguard will try and change this, but I think in 10 or 20 years from now, what we'll probably see is a different way that these types of things are put together. So, for example, I don't want to feel like I'm talking my own book, but say, for example, you invested with us, right? This is not me trying to sell it, but say, for example, you invested with us, and in 5 years, you wanted to change from a high growth strategy to a balanced strategy. Now, in some instances, like if you only had one ETF, you would have to sell the ETF, the whole ETF, like part of the ETF, you would have to sell it and then put it in the other stuff. You'd have to change the option. So you'd go from high growth or all growth to balanced. And that would crystallize a lot of tax for a lot of people. You would go and you would sell and you would incur all the tax, and then you would switch to another option when really it still holds many of the same buckets. It's just a different basket. So you're kind of just like swapping a basket with different buckets inside it. But the buckets are effectively the same because they're just mixed in a different way. And so the reason that I don't think they're perfect is that if you, say, built your own ETF portfolio using Perla or invested with us, effectively what you could do is, let's say in 10 years, when your investments are bigger than they are today because you've done a really good job and so on and so forth, if you decided that you wanted to switch from one strategy to the other strategy, so high growth to balanced, you don't need to sell the whole darn thing, do you? You only need to sell the few investments that then change it from high growth to balance. You just sell some of the growth stuff and you buy more of the defensive stuff. So then they're a balanced strategy. And so that's a far superior option, in my opinion, than having a massive portfolio in just one ETF. And so obviously I'm going to advocate for diversified portfolios, not just like single ETF, like single asset class portfolios. So I hope that makes sense. But I think for now, if someone was beginning their ETF journey, those things are amazing. They're actually wonderful. But I think if you get a bigger portfolio and you start to develop your investing strategy and you're starting to feel the effects of saving and investing, and you're thinking, you know what, gosh, I might actually have $500,000 or $1 million or $10 million by the time I retire, who knows what. That's where you need to start thinking, what is the best option for me in 20 years? Not just what's the best and easiest option right now. And I think that's the key difference. There's many differences. I mentioned tax differences before, but there are many differences, but that's the way I think about it. So yeah, I hope that explains some of the questions. I'm not like anti anything, but maybe there's a little bit of anti crypto in me. But okay, so this is today. Let me know what you think in the comments if you watch this back. Let me know. Jump in the community. Say g'day. Take advantage of all the free stuff we've got. Use the community. If you're investing with us, you can expect an update from us in the next week on certain things. But yeah, jump in the community. Say g'day. Let us know what's going on. In the future, we're going to take more of this portfolio and start building it together. So dump all your ideas in the comments, and that's it for now. That's all, folks, as they say. Have a wonderful week. I'll be back next Thursday, and we'll keep growing this live show together. We'll start bringing some experts in as well. My name's Owen Rask. You can learn more about Rask online. Don't forget some of our wonderful partners there that are helping us out. So thank you. Mike, thanks for that comment as well. Cool. Move from $6 to Perla. Cool. Nice, mate. Well done. Okay. Have a wonderful day. Stay safe. I'll see you next week. And let's just hope for more good economic news like we had yesterday. That's good for us. All right. Bye for now, everyone. Thank you so much for joining me.